So we've challenged you, the investor, the last couple weeks to know, what do you really believe? Who are you as an investor? As promised, this week we're going to take some time under the spotlight to tell you who we are, what we believe, and the types of things we work through with clients to help them reach their goals. So the last 2 weeks, we've looked at questions that were meant to challenge you to really reflect on who are you as an investor? What do you believe? What are those challenges that you need to overcome in terms of fears? Is it a fear of missing out, or is it a fear of losing money? As promised, I wanted to take my turn under the spotlight to share some of my history and the things that have influenced me as an investor, as well as the process I now walk through, which I hope you can take and put onto your own personal story and approach. So I got my start in investing in 1995. For the first few years, for those of you who were investing at that time, things were easy. Didn't believe in diversification, didn't see the point of it. You bought up just about anything and it went up. Totally chased performance, was all about a fear of missing out, and that all worked really, really well. I started with about $2,000 that I had cobbled together from parts of my summer earnings over a few years, and I'll never forget I had grown that up to about $20,000 in trading various stocks, only to wake up one morning and find out that that final biotech stock that I had everything in that had made me so much money had essentially gone to zero. And I learned a number of things from that. Number one, investing is tough. For a moment in time, the risk-return profiles can get bent and lull you into a false sense of security, but gravity comes back in force when it's there. Number two, it's a very complicated game filled with a lot of smart people that needs to be approached from a humble fashion. I learned that my risk profile wasn't as great as I thought it was. I didn't like losing 0% money. I learned that no matter how many percent you're up, 100% wipes out everything that you've put together. And that shaped me, thankfully, in a really constructive way. It was the best $20,000 lesson I ever bought, because it helped get me ready for what was to come in 2008, when I was responsible not only for my own money, but clients, and has shaped how I take care of people since. So, some things that came out of that. Again, do I believe in diversification? Absolutely. I didn't like that experience of losing everything that I had worked for. And as we'll touch on a little bit, I became to understand the importance from an emotional perspective of always having something that you can anchor to and finding a win somewhere within what you're doing to take confidence from. I understood the power of mean reversion, whether that's things that have been way down coming up or things that have been riding high coming down. That again was an economic market gravity that I was subject to just like everybody else. Also really learned to study corrections. Certainly for a period of time, I shifted to a losing money mindset, perhaps as my predominant mindset, and that can be paralyzing in its own respect. And so I really became a student of history and the math behind things, understanding probabilities at a much, much higher level. And again, not thinking I was special, but assuming that economic gravity, those probabilities would continue to play out, and I wanted to be on the right side of that more times than not. Finally, I learned things don't go according to plan. Of course, that 20,000 was all set to become 2 million in my mind, only to see that all come crashing down. And there's a great market adage that I think is important for people to keep in mind, which is the market will do whatever will hurt the most people. Sounds pretty bleak, but if you think about how many of your friends and family had piled into tech stocks right before the crash in 2000, 2001, or were trying to flip real estate right before 2008, or getting tempted by Bitcoin last year, it's true. Those hopping on the momentum plays, hopping into the things, it seems like the easy trade, the thing that has been going up, inevitably leads to some tough places. So with that then comes a mindset. Number one of which is just embrace those realities, embrace these market truths. Don't believe that they don't apply to you. It's going to lead to a tough place. And so my process, again, is driven very much off understanding those probabilities, believing in those diversification and mean reversion truths, and knowing that the key thing I just need to add to that is patience. And with that, then I can get paid. Understanding the trade-offs that I need to make. Do I have short-term needs? What can I afford to really put away? What am I willing to put at risk, are key questions that everybody needs to ask. But rather than, again, focusing on, well, what if this dollar could be better put somewhere else? That's that fear of missing out side of our brains. Or what if the market's about to crash? Understanding from a more long-term perspective, what is it that I need? And then two, what specifically is this investment going to help me achieve, can hopefully help you get away with that. You're not buying this thing for the next year or 2 years, hopefully in most cases. You're not buying this thing because you believe it's going to be the only best thing here over the next few years. It's because it plays a specific role in your plan. And so I invest in that same way. I have those things that are there building and reinvesting income to help me pay over time, and those things that I've bought to be more tax sensitive and more capital appreciation focused. And we'll get into that in a little bit. That brings us to logistics. For me, it's kind of a 5-step process that I walk through from a very, very high level. There's, of course, subparts, but number one is, what is that true risk profile? For me, I bifurcate my mind between the different accounts I have. I have my retirement accounts, my 401k, I have my non-retirement account. I'm much, much more aggressive, for reasons we'll get into, within my after-tax account than I am within my 401ks. And so with that, as I get the different volatility experiences, I'm okay with that because I understand that was the cost, the trade-off for the focus that I chose to have for that account. Second, and related to that, is my ability to add money. I'm capped, as we all are, in terms of how much we can put into an IRA or Roth, and that impacts how you can dollar cost average into investments if you are early in the trade and they do go back down, and that needs to be factored in. Or maybe you're retired and you don't have any more income coming in to replace. That's going to play into, again, how that portfolio is constructed. For people who are more in an after-tax situation, still working, still being able to put away, again, maybe you can afford to take a little bit more risk, knowing that if things weaken, you can dollar cost average in at lower prices. Number three, do you need income? For those people who, again, are retired, or even if you're not, are relying on their portfolios to supplement some income, that needs to be taken into account because you don't want to be forced into a position where you have to liquidate something before you want. Taxes. Can you tax lost harvest or not? Obviously, if it's in a retirement account, you can. If it's an after-tax money, if it's an after-tax money, you can. That plays a big role in returns that people don't think about when they're just thinking about buying it at X and selling it at Y. But again, can over time make a big difference in what your net return is. And finally, and going back to the first story, being able to find a win. I guess in some ways I get to look back at that lesson in 2000 and I learned an important lesson, and that's very true, but I also want to find a win financially for myself and clients. I believe that's important to be able to anchor to or take confidence from through very challenging times, and that's why that role of diversification becomes so key. And if we fast forward to where we were in 2008, when there were fixed income positions within an account, even though real estate and other things were flying high, those were those positions we could, again, take confidence from and, again, add money to, if you will, by liquidating them to buy things that had been beaten up. It's not possible to do that, again, without that diversification within portfolios. An important lesson, again, emotionally to be able to take heart from, and logistically to dollar cost average into. So this is who we are. This is a little look at part of the process at us outside of individual security selection. We hope this has been of help. Thanks so much.